Record money is flooding into stocks, just as the real economy begins to fracture, and history shows this is exactly when the biggest financial traps are sprung. Over the past few weeks, an astonishing wave of capital has poured into U.S. equities. More than $20 billion has recently surged into the Vanguard S&P 500 ETF alone, adding to an already massive flow of funds entering the stock market in 2025. Since the start of the year, roughly $125 billion has been funneled into this single index. On the surface, this looks like confidence. It looks like optimism. It looks like investors embracing strength. But when we step back and look at what's happening beneath the surface of the economy, a far more troubling picture begins to emerge. While money rushes into stocks at a record pace, the U.S. labor market has been quietly deteriorating. Over the course of 2025, companies have announced 2 million job cuts, marking the largest wave of layoffs since the pandemic year of 2020. This surge in job losses has pushed the unemployment rate up to 4.6%, a level that has historically acted as an early warning sign of recession. In fact, this threshold activates what economists often call the Somme rule, a condition that has only been triggered at the very beginning of past economic downturns. When unemployment begins to accelerate, history tells us it is not something investors should ever ignore. If we look back across market history, some of the most painful drawdowns in the S&P 500 have occurred during periods when unemployment was rising. This relationship has repeated itself again and again. And yet, despite these warning signs, capital is still flooding into stocks. To many observers, this looks like a textbook case of investors charging into the market at precisely the wrong time, when economic conditions are starting to unravel rather than strengthen. Whether this behavior is intentional or simply the result of incentives built into the financial system, the outcome is the same. The structure of modern markets tends to push investors toward risk assets right near the top. As layoffs increase and growth slows, central banks step in with interest rate cuts to soften the economic blow. Lower rates reduce the appeal of holding cash and encourage people to seek returns elsewhere in equities, real estate, or speculative assets. Ironically, the very policies designed to stabilize the economy often pull investors deeper into risk, just as the cycle begins to turn. The problem, of course, is that economic cycles do not stop deteriorating simply because rates are cut. Weakness often continues until it becomes a full contraction. When that happens, asset prices that were lifted by easy money tend to roll over sharply. We saw this exact sequence play out in 2007. At that time, the S&P 500 was pushing to new all-time highs, fueled by Federal Reserve rate cuts aimed at cushioning an already weakening economy. Those cuts made cash unattractive and encouraged investors to chase stocks. In the final stages of that rally, margin debt exploded. Investors piled on leverage, adding roughly $150 billion in borrowed money to their equity positions. All of this occurred just as unemployment was starting to rise, a warning signal that was largely ignored. The result was catastrophic. Investors were lured into stocks at the peak, only to be crushed by the onset of the global financial crisis shortly thereafter. At first glance, today's environment appears eerily similar. Once again, we see aggressive inflows into equities, soaring leverage, and a labor market that is beginning to crack. Margin debt is rising rapidly, and valuations are stretched. It's tempting to conclude that history is repeating itself exactly. But markets rarely move in perfect copies. Instead, they tend to rhyme. One of the most important differences today lies in valuations. The S&P 500's price-to-earnings ratio currently sits near 22.5, placing the market among the most expensive levels ever recorded. This metric measures how much investors are willing to pay for each dollar of corporate earnings, and at these levels, optimism is baked deeply into prices. When interest rates fall, they don't just encourage investors to buy stocks, they encourage them to buy stocks at historically elevated valuations. That combination is where danger begins to build. Long-term data makes this clear. When the S&P 500 is purchased at low valuation levels, the following decade has historically delivered strong returns. When investors buy at very high valuations, the next 10 years tend to be disappointing at best. In fact, valuation alone explains a significant portion of long-term returns. Based on today's starting point, the data suggests that the S&P 500's total return over the next decade could be close to zero in real terms. From that perspective, the massive retail inflows of 2025 may eventually be remembered as one of the worst possible moments to commit long-term capital to stocks. But valuations, while powerful over long horizons, tell us very little about what happens next month or even next year. When we examine 1-year returns instead of 10-year returns, the relationship nearly disappears. Markets can fall after being cheap, and they can continue rising even when they are extremely expensive. This creates the central question investors face today. Are we already at the peak? Or is there still more upside ahead before the cycle finally turns? Valuations alone cannot answer that. And this uncertainty is exactly why a purely passive approach may struggle in the years ahead. While every investor should have some exposure to long-term, diversified investments, the coming decade may reward those who also adopt a more active strategy. An environment defined by stretched valuations, rapid technological change, and shifting monetary policy creates opportunities for selective positioning, provided risk is managed correctly. Active investing doesn't require complex math or insider knowledge. What it does require is a structured system and discipline. This philosophy is precisely why Bravos Research was created. After more than a decade of refining our approach, we developed a framework that focuses on macro conditions, sector leadership, and risk control. Over the years, we've watched countless individuals lose large sums of money simply because they entered the market without a plan or held positions far longer than conditions justified. Compared to those losses, the cost of learning a disciplined system is minimal. That said, no strategy guarantees success. Markets are inherently uncertain, but understanding how professionals actually approach macro-driven markets can dramatically improve decision-making. For those serious about learning this process, our current New Year offering provides access to the tools and models we've refined through years of trial and error. To understand where we are today, it's also helpful to examine what has marked previous market peaks. The tops in 1999, 2008, and 2020 were all associated with shifts in underlying earnings dynamics. Over long periods, stock prices and corporate earnings tend to move together. Earnings are the foundation that ultimately supports valuations. One might assume that rising unemployment would already be dragging earnings lower. Surprisingly, that hasn't happened. In fact, S&P 500 earnings have continued to rise, and not just modestly, but at an accelerating pace. This divergence between labor market weakness and earnings strength is unusual, but it has a clear driver. When we break earnings growth down by sector in 2025, one group stands far above the rest: information technology. Tech companies have delivered roughly 21% earnings growth this year alone, fueled by massive investment in artificial intelligence. Capital spending on AI infrastructure has surged since 2023, closely resembling the investment boom in internet technology during the late 1990s. This concentration matters. The market strength today is not broad-based in the traditional sense. It is being driven by a powerful technological theme. That makes the current environment far more similar to 1999 than to 2008. In the late 1990s, economic cracks were already forming, but technology-driven earnings growth kept the market climbing. The bull market didn't end because valuations were high. It ended when monetary conditions finally tightened. In 2000, the Federal Reserve began raising interest rates again. That shift removed the liquidity supporting speculative growth, and the bubble collapsed. Today, by contrast, the Federal Reserve is moving in the opposite direction. Rates are being cut, not raised. In fact, this pattern closely mirrors the 5 years leading up to the dot-com peak, when policy remained accommodative even as valuations stretched further and further. As counterintuitive as it may sound, this suggests the bull market may not yet be finished. This view is not new. Since late 2023, when the Federal Reserve began easing policy, we've consistently highlighted the potential for continued upside despite widespread concerns about valuations. That perspective allowed us to remain invested in leading stocks throughout 2025, capturing strong trends while managing downside risk. Our process involves scanning global markets to identify outliers, stocks and sectors that continue to attract capital even in late cycle conditions. This approach doesn't require constant monitoring or full-time dedication. With a few focused hours each week, disciplined investors can apply the same principles professionals use to navigate complex environments. As the year turns and volatility inevitably increases, the key takeaway is this: the market is not collapsing because valuations are high. It will eventually turn when earnings momentum fades or when liquidity conditions reverse. Until then, blind optimism and blind pessimism are equally dangerous. Understanding where we are in the cycle and adjusting exposure accordingly is what separates long-term success from costly mistakes.